Whenever we talk about successful stock market owners, hedge fund owners, or financial tycoons, Peter Lynch is right up there. Peter Lynch is one of the most successful and well-known investors in the world, being the managers of the Magellan Fund Fidelity Investment from 1977 to 1990. Lynch averaged a 29.2% annual return, which is greater than Warren Buffett's average rate of return over the decades he is investing. And furthermore, if you don't know already, this return rate was more than double of the S&P 500 stock market index, which made him the most successful fund manager throughout the globe. He has written vastly, and his books like One Up on Wall Street and Beating the Street have revolutionized the way many value investors look at the stock market. But don't worry, you won't have to go searching for these books because we're going to summarize all of his investing wisdom today. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. 29.2% of annual returns. To put it straight, no one has achieved those booming annual returns with large money over the course of 13 years. But Lynch pulled it off. Now, he did this by using some simple rules and principles, which are unfortunately made very complex by some old school financial pundits. So let's dive in and understand Lynch's wisdom. According to Peter Lynch, it's a tragedy that the small investor has been convinced by the media, the print media, the radio, and the television media, that they don't have a chance. The big institutions with all their computers and all their degrees and all their money have all the edges, but this belief is far from reality. The real problems start for a beginner investor, start when they start believing everything that is being fed to them through all types of media. For example, this belief of being inferior to bigger institutions when it comes to returns is going to enforce them to buy stocks for a week, and then they buy options, and then they move towards, let us say, the Argentinian fund, and in the next week they go for a Chile fund. When this happens, they're going to get results proportional to that kind of investing. You can't expect to sow apple seeds and reap mangoes. Peter Lynch has vastly stressed the idea that people can make money in the stock market on their own. Furthermore, the large institutions dominating the market is a positive result for small investors because sooner or later, these institutions are going to push stocks on usual lows and on unusual highs as well. Small investors have a big advantage. According to Peter Lynch, the single most important thing for a value investor in the stock market is to actually know what you own. There are many people out there who own stocks and they cannot tell why they own these stocks in the first place. Lynch stresses that if you can't explain it to a 2-year-old that why you own a stock, then you shouldn't buy it. For example, when you go hunting for a stock, you should always start with the business model, instead of relying on the fact that your neighbor made money investing in that particular stock. Now, if you're going after the Coca-Cola stock, then you should understand the business model and have a detailed understanding of their finances and the growth of the stock in general. Now, we all know that Coca-Cola, KO, is one of the largest beverage companies with a big geographical presence. And how are they making their money? Their revenues are usually generated by the sales of a variety of beverages, water, and enhanced sports drinks. Furthermore, their product has to compete with other fruit drinks, energy drinks, and various carbonated as well as healthier things. Lynch also exemplifies that he made 10 or even 15 times his money in Dunkin' Donuts, even during the times of recession. And he made that money because he understood the underlying business model and people were always going to come out and buy this product no matter what. Analyzing stocks is one of the best ways to develop a strong portfolio in the stock market. This is the reason we provided you guys with a free guide in the description below, which explains the 6 stock categories everyone should know about. The principle is simple. If you don't understand, things won't work out that good and smooth for you. Coming back to Lynch's wisdom, the legendary fund owner wants you to stop depending on others' opinions about various stocks and don't invest purely on others' opinions. There are reasons that stocks go up. For example, Coca-Cola was earning 30 times per share on what they did 32 years ago, and the stock has gone up 30-fold. And similarly, Bethlehem Steel, which got dissolved in 2003, at the same period of time they were nearing bankruptcy and were 30 times down than what their stock once actually looked like. Now, stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock will do well. It's not that complicated. So Lynch simply wants you to focus on the company behind the stock. Now, most of the time, people get too carried away and they try to predict the market. or they depend on certain financial pundits to handle the decision-making game for them. According to Peter Lynch, that is a total waste of time, and no one can actually predict the stock market, and they would be lying to you if they say they can. The economic predictions are a total waste. Let's understand this with an example. Carl and Peter are two friends studying in a business school, and both of them take their financial independence as an utmost priority. They like researching various stocks and business models. They like to attend seminars and were even lucky enough to attend a seminar by the legendary Warren Buffett. But both of them had some stark contrasts in their characters and the way they went about their investing careers. On one side, Carl was all about analysing stocks, and on the other hand, Peter usually relied on popular opinions formed by various investing pundits, neighbours, relatives, and friends. When Carl decided to invest in a stock, which was related to the automobile industry, he started to look after all those car prices, and he took the car prices going up as a very good indicator to invest his money. And similarly, when he decided to go after some hotel stocks, he started to look into hotel occupancies. He started to look into the price of ethylene when he got interested in chemical stocks. And similarly, when the aluminium industries went down 5 straight months, he took that as an indicator and directed his investments accordingly. Overall, he was reliant on market indicators and facts for his investing decisions. He was always studying history and various trends about the pricing of companies and historical trends. He made great money and has quadrupled his investments over time. On the other hand, we have Peter, who, due to an opinion formed by one of his relatives, invested in a small startup and also invested in a steel mill because his wife wanted him to do so, and ended up losing a lot of money and is now closing up on bankruptcy. You can choose your preferred example. When the market goes down, it goes down a lot. The math is simple and straightforward, and roughly the market falls once every 2 years, and the shortage is more than 10%. We call that a correction. But when a crash is more than 20%, that is known as a bear market, and they also appear once every 5 years or 4 years roughly. We should all understand that the market is going to go down sometime. We can actually take advantage of these declines. You can buy when their price is low, and the stock price is very likely to go up in the long term. You should look at the balance sheet of the company. If they're doing great, you should be very happy. For example, Walmart went public in October of 1970. It had great performance in the next 16 years and had a great balance sheet. Now, you would have waited for 10 years saying that you're a very conservative investor. But even after 10 years, when you finally decided to invest, you would have made 35 times your money. Investors actually underestimate the amount of time they have at their disposal. If you bought Walmart at the time it went public, you would have made 500 times your money. Similarly, if you waited 3 years after Microsoft went public, you would have made 10 times your money. Again, stocks are not lottery tickets we have at our disposal. If we understand the stocks, wait for the appropriate time, complete our homework, we're bound to make money. And this is what most of the value investors often end up overlooking. Everything starts with analysing stocks, and Lynch's wisdom is certainly the best way to start making your money in the stock market. Make sure you press the subscribe button because we're going to reply to everyone who comments subscribed after doing so. Check out the video we handpicked for you, and we'll see you in the next one.